Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir. I'm joined as always by David Broomfield. Hello, David.
Hello, Sarah.
Have you recovered from last week's market volatility?
I have. It was a bit of a rude awakening, wasn't it? Back from holiday straight into the thick of it.
It was a little bit, but I know that. I know we'll get to what the three things are in a minute, but it does relate to that. But I know that you did a little bit of research based on if you'd invested the night. Was it the day before everything kicked off and you looked at your investment today, what would we see?
Well, I think that's the point, right? If you blink, you miss it. And maybe, ignorance is bliss if you're on the sun lounger and not paying attention to markets, because if you invested, let's say, just before non-farm payrolls, which were on the 2nd of August, which is kind of what lit the touch paper to all of this, in sterling terms, if you're in the S&P 500 as of yesterday, you'd broadly flat. You'd be down just under 1%, but the peak drawdown was around 8%. So it's been a wild roller coaster. And I mean, if you were the other side of the world investing on the Nikkei in those trading sessions that followed in Japan on Monday the 5th, I mean, it was really wild. You had down 20%, up 14%, down 4%, up 9%, down 6%, just in the 5 sessions. Just in that week that followed. So it's been a real roller coaster.
Yeah. Okay. So we're going to reflect. We're not going to talk about the fundamentals because in our last podcast we looked at how much of the market volatility was caused by fundamentals and how much of it was caused by sort of technical factors. And we're going to explore that in a little bit more detail this week, aren't we? So what are the three things you want us to look at?
Well, I think, now some time has passed since that volatility. We'll have a bit of a retrospective. And the bits that I think are quite interesting are more technical than fundamental. As you said, we talked about the fundamentals of the US economy and how, as the data subsequently has shown, the US economy isn't in bad shape at all. But the technicals, I think, are what are interesting, and they're driven by volatility being low for a long time. So the three things will be, let's talk about the carry trade and get under the bonnet of that. It's something that has been around and been in the press for decades, on and off. And then we'll talk about the lesser covered trade, which is called a dispersion trade. Mm-hmm. And then I think the third thing, which is sort of related, but it's not a kind of carry trade. It's about covered call ETFs. And they've been making a few headlines over the last week because I think they've caught a number of investors by surprise.
Yeah, I think a few things have sort of been thrown up off the back of the recent volatility. Okay, let's kick off then with the carry trade. A quick reminder, very simple terms. What are we talking about? What is a carry trade?
Well, carry trades are really simple. And there's one thing that throughout today's podcast you're going to hear a lot is that the world has been in a very low volatile environment for some time, and carry trades require low volatility while you essentially harvest coupons. So what does that mean? Well, the name kind of explains it all. You are literally carrying something from one place to another. And in this case, this example of the carry trade, what you're carrying is basically Japanese yen. You borrow Japanese yen because interest rates in Japan are very low or have been very low. That makes the yen extremely cheap. And it's been cheap relative to the US and other major currencies for some time. And by borrowing in yen, you pay less. And when you repay, you're likely to be repaying on cheaper terms in dollar terms, right? So what you do is you borrow cheap Japanese yen, and then you go invest it somewhere else. You go invest it in a higher yield somewhere else in the world. And that can vary. It could be Mexican pesos, it could be Brazilian real, or it could simply be US dollars and US denominated assets. And to bring that to life, if you're borrowing, let's say, for 0.25% in Japan, you could be investing in Brazilian real that's 10% plus yield.
Okay.
And providing the volatility stays low, providing the currencies don't fluctuate materially, and your expectations are that interest rates in Japan will be low, interest rates in Brazil will be high, you're profiting a nice tidy sum between those two pairs. And that's just one example. These currency carry trades aren't uncommon. They've been around for a while. They're generally employed by more short-term market participants, hedge funds, CTAs for those in the know, commodity trading advisors, and other kind of quantity type funds that have lots of different incarnations, but they all work on statistical stability between different assets.
Okay, so one of the things we talked about on the last podcast was how the unwinding of those trades was part of what drove a lot of that market volatility. Why? What happens when those trades are unwound?
Well, this is the shock, right? And this is what the market experienced. So the shock is affecting effectively those people who are short yen, those people who have borrowed yen and exchanged them from dollars, are in now an environment where interest rate expectations are changing. So in Japan, which is seeing some inflationary pressure for the first time in many years, interest rates are rising, and that's coupled with capital flows into Japan, into the Japanese stock market. If you're in the Bank of Japan, you're looking at the domestic market thinking, okay, we've got some latitude now, finally, to raise interest rates. That's a shock for anyone who has been engaged in this trade. A huge shock. So what happens is money, eventually these trades unwind, money flows back into Japan, the yen appreciates, so it improves in value against the dollar. And then the Japanese stock market sells off. Why does Japanese stock market sell off? Well, as the yen appreciates, any Japanese company that's exporting in yen, it's a more difficult export environment for them with a stronger currency that they've been used to in terms of their capital stack, their corporate structuring. Their assumptions for decades have been a weak yen, and all of a sudden that calculus is changing. It's a really substantial flow. That's the shock. You unwind the trade, and I tried my hardest, I have over the last week, to get some numbers on how big those flows are, and I want to get this in perspective because it's really important to understand that in terms of then where we go from here. You know, the carry trades that are unwound over the last couple of weeks, they're in the orders of magnitude of low trillions. Okay, I mean, these are huge numbers, and I'm sort of rounding them. But put that into context, the repo market in US Treasuries is around $2 to $3 trillion a day. The global FX markets are around $7 trillion a day. So low trillions is big, but I suspect this isn't all of the carry trade unwound. This is a portion of it.
Right. Is it fair to say, I mean, the carry trade's been around for a while, it's not a new thing, but is it fair to say that it really took off when the US stopped QE and started moving away from zero interest rates? Is that the trigger that really made it attractive?
I wouldn't say it's the trigger. I mean, we've lived through a period, like if you go back through history and look at the dollar, we've post Bretton Woods, when, you know, the gold standard was abandoned and we sort of adopted fiat currency, you've had a period of dollar weakness. I mean, one of the reasons the dollar is a global reserve currency, and this is counterintuitive to everyone that thinks that, oh, reserve currencies are surely really strong currencies. They're not. They're actually very weak currencies that can be issued rapidly with no bottom line. So the whole reason that the Fed is the global central bank and not the ECB is because the Fed is willing to fill anyone's order with dollars if they need them. So we've had this period of weak US dollar, and then we've had now a period of relative dollar strength. I don't think it's the end of QE, because the QE story has been mixed over the last few years. But it's certainly a divergence post-pandemic in terms of relative US strength compared to rest of world. So we have seen this over recent years, this appreciation in dollar. It's all a relative game relative to other countries. So it's related, but I don't think it's a trigger. Okay.
And then I guess my final question on this is, if we go back to what triggered it in the first place, which was the Bank of Japan raising interest rates by 25 basis points, which there's still a huge difference between base rates in US and Japan. Is this all then about expectation and where people think interest rates are going? Because it doesn't really impact it now, does it?
No, it's exactly about expectations. And it's about, you know, if you borrow something, you want some certainty when you have to repay that borrowing of both the currency volatility and the relative rates between those two currency pairs. The carry trade has been going on not just between, you know, Japanese yen and US dollar. For those that have Bloomberg or want to go and Google it, go and look at the Mexican peso chart. That's wild. Whoever was trading Japanese yen and Mexico pesos had an incredible summer holiday. So yes, you're right. There's still money to be made here, but these quant funds, these CTAs, these hedge funds that operate this kind of model, it's about repositioning assets. Okay,
Yeah.
so in many cases, I don't want to make sweeping generalizations too much, but in many cases, some of these funds, it would have been almost a straight through automated process to rebalance and reposition portfolios away from carry trades like this into other assets and asset classes. And it's all of these things happening together, correlating, all of that money being repatriated to Japan, further appreciating the yen, compounding the existing problem that creates that kind of snowballing type effect. So yeah, it's still viable, but markets aren't the economy, and it's a lot about expectations. It's all about expectations.
Okay, so that's the carry trade. We talked about that last week, and there's quite a bit in the press about it. I saw less about the dispersion trade. So explain to me what that is and how it works.
Yeah, well, it's all around the same idea. I think we should all lump these into one bucket called low volatility trades. Okay, because a carry trade implies like, oh, you're just being smart between interest rates and currency differentials, but really what's driving it is low volatility trades. So, for instance, there are loads of different low volatility trades. We'll come on to dispersion trades in a second. You could trade credit spreads, VIX roll down strategies. I mean, there's loads of them. They're vol-on-vol trades, as they're colloquially sort of known. And the crucial thing is all about volatility. And when we come on to dispersion trades, I'll sort of bring this home. But the payoff of all of these trades, if volatility is low, actually is pretty good. They tend to be profitable about 80% of the time. I think in statistics you call that positive drift, but they have a very fat left tail. What does that mean in statistics? It means that when things go wrong, they go massively wrong, hugely wrong. And that's why you see rapid unwinds in these types of trades. Dispersion trade is a unique form of a low volatility trade. It didn't get enough headlines, I think, over the last couple of weeks. But it works on exactly the same premise as that yen carry trade. And a number of other relatively speculative bets that have been put on equity markets in the US over the last 18 months or so. So it all works around this idea that the markets become really complacent on volatility. And a dispersion trade is quite straightforward. You sell the volatility using derivatives on the index, in this case, the S&P 500, and you buy volatility on the individual stocks that make up the S&P 500. So the idea, very simply, is that the volatility on the index should always be lower than the volatility on the underlying stocks, because the index is nice and diversified, and not all the stocks are fully correlated with each other, so it should have a lower vol. Now, back to my evergreen point, as long as volatility remains low and the correlation between those stocks remains low, an investor can pocket the difference between the index and the underlying vol. But those that were listening attentively will recognize that when I said the use of derivatives to do this, it kind of implies leverage. Some of these trades are very, very, very leveraged.
Right.
And so with VIX for so low, VIX is the measure of expected kind of volatility in the market. With VIX so low for so long, there's probably been an awful lot of dispersion trades happening, I would say.
Yeah.
And so when you see, it's always the case, this sort of transitivity of A to B to C to D, like, non-farm payrolls trigger some changing interest rate expectations. Carry trade causes big currency volatility. Positions unwind. General index volatility goes sky high. And then all of a sudden, dispersion trades don't work anymore, and derivatives get closed out. And then you can sort of see this. This is the vector, how you leave from sort of one thing happening in Japan all of a sudden to an esoteric trade on the US index unwinding over the subsequent week.
And there's no doubt that this long period we've had of very low volatility has allowed people to build up what potentially very outsized positions in some of these trades.
Potentially, yeah. I mean, it's really tough to get data on this. I mean, the investment banks try their hardest to compile data on these various types of trades. I've seen lots of numbers go around the last couple of weeks suggesting that about a third of these types of trades have unwound. Some saying as many as half. I'm going to be a little bit facetious and say I don't think anyone really knows. It's very, very difficult. I kind of believe in this Minsky paradox that stability creates instability, and when you have a certainty, well, a perceived certainty, like low interest rates forever or low inflation forever. And we saw the same thing running into 2022 with people's expectations that yields would remain low forevermore. It does create unintended consequences. So I would suggest that we're not over yet. I think there's probably more of these unwinds to come, I would say.
I was going to say, because we don't know how many of these positions remain. Now, but I guess my next question is that we're recording this in August, which was traditionally very low volumes in markets, because you say everybody's sitting on the sun lounger enjoying themselves. And that can raise volatility because you don't need very much to kind of shift the dial. Does that mean then perhaps if we can get to September without another big piece of news moving markets, like, I don't know, NVIDIA earnings or I don't know, CPI number coming out that's kind of shocks people, could this kind of maybe disappear a little bit if we get to September when volumes pick up again? Or it could still happen?
I think there's some of that. I think that seasonality clearly has an effect. But we should all recognize a couple of things. We should recognize that listed markets are becoming less liquid over time. I mean, the US market is in stark contrast to other regional markets. I mean, the US market is very liquid, but other regional markets less so. And yeah, there's some seasonality. I think you're right. But also, you've got some concentration with many people owning the same stocks as well. So, herd behavior plays a part, I think. But we shouldn't ever become complacent about volatility. I think that's the point. Yeah. If you see VIX at levels sub 10, which it's been incredibly low for a number of months. It should be, it's not a warning bell per se, but you should recognize that go and look at a chart of VIX over a much longer time period, and you'll see that when volatility hits, it hits very hard and it hits very quickly. And I think my contention is that we're in a period now where you get sharper bouts of volatility, quite extreme, quite hard hitting, but they might not persist. And it's the nature of the shock that defines whether volatility persists or not, I think.
I was just going to say, how much of that is down to things like algorithmic trading, that you get these immediate instant reactions to pieces of news before somebody's actually had a moment to digest that piece of news and think about it and think actually what it means?
Yeah, look, we've had a number of these sort of flash crashes over the last 7 years. And they've been, I can think of at least 3 that have been short-lived. It does play a part. If you go back and look at a chart of the volume on the number of trades on an exchange and the size of those trades, you see a simple relationship that the size of trades over time, over decades, has got smaller, and the volume of trading has gone up massively. As I've said this, I think, on the podcast before, that you can't view a stock exchange anymore. I explain this to my extended family who aren't market practitioners, that there is no way to visually capture trading activity on an exchange anymore, because the refresh rate of that activity is faster than your visual acuity, right? It's faster than the refresh rate of a computer screen. So my point is that the vast majority of trading out there today is kind of, I'm going to say, algorithmic already. There's no real open outcry trading anymore. But I think that's flippant. The reality is that quant funds, systematic funds, CTAs, hedge funds are quite big forces in the market, and bigger forces of short-term volatility than perhaps they have been in the past. So I think you're right. Some of this, and we'll have to see how things like AI trading and other things impact on this in the future. Maybe AI will be more intelligent than some of the black boxes that work today. I don't know.
We'll see. We'll have to see. They'll have to get those power plants sorted out and the power grid sorted out. You have to listen back to a previous episode of Need to Know to find out all about that. All right. So we've talked about how the unwinding of these dispersion trades and carry trades played a part in last week's volatility. So I guess the solution to that is a covered call ETF, is it?
You'd think we should probably spend some time just talking about what a covered call ETF is, right? They've gained they've gained a lot in popularity the last couple of years. So what they do, a covered call ETF, it's an ETF for those out there who aren't familiar, is just a fund, effectively, and covered calls are basically options. Okay, so how a covered call ETF works is it generates income by writing call options on the securities that it holds. So what you do is you basically lend that stock out, you get an income. But what does that mean? That means clearly, once you've lent the stock out, you don't participate in any upside of that stock or limited upside of that stock. But you do receive a nice income for that contract. There's been big demand for these, which on the face of it, people might be listening thinking, well, why is that? Because why would you want an income when yields have been rising and we're clearly in a bull market? I mean, I find this quite curious, and we might need to do a bit more research on it, why there's been such appetite for these, because I suppose maybe people think that the market's run too far and can't go any further. So they view it as maybe downside protection. Not sure.
Wouldn't you just, surely a classic 60-40 portfolio would fulfill the same function, wouldn't it?
A different function. We'll come on to that in a minute, because the 60-40 portfolio works very well when you have growth type shocks. Okay. And that's arguably kind of the murmurings of what we may experience in the months and years to come will be growth shocks. And why does 60-40 work in growth shocks? Well, central banks cut interest rates, bonds rally. So it protects your downside that way. By contrast, covered calls, whose flows have been, as I said, they've gained in popularity. I think flows have pretty much doubled over the last year alone, from about from around sort of 40 billion to around 80 billion. There've been huge flows. But
I saw, sorry to interrupt you a minute, I saw a figure that was 18 billion in 2022 and around 80 billion assets under management now.
There you go. So yeah, it's seen significant popularity. So why doesn't it work for the downside? So again, go back to this point. In theory, they should do okay as volatility increases, because call option premiums tend to rise along with volatility. Okay, so they should be clipping that income from the option strategy that should offset little losses as the underlying equities sell off. And generally speaking, that works. I'm going to say two things here, though. First thing is that getting your options writing strategy right is key. And over the years, I've seen many funds fall over not getting their option writing strategy right. And let's look at some real examples. In fact, I won't mention the names of the funds. One fund I looked at over the first half of this year was up around 7.3%. This is a covered call ETF. I found an equivalent fund, same holdings, different success in their options writing strategy, up 14.5%, nearly double the performance of the other fund.
And so that's just in the option writing, isn't it? Because they're holding essentially the same stocks.
Yep.
It's the kind of black box bit on the other side that they've got right or got wrong.
Well, it's either a black box or it's an individual. In my career, I've worked with people who have gone from investment bank derivative trading desk to fund managers doing effectively the same thing, just writing call options on those baskets of stocks. So, you clip the premium from the option, and as volatility rises, those premiums should increase. And that's a buffer against minor drops in the underlying, right? It's not a panacea for downside protection. And of course, as volatility rises and the underlying assets have big price swings, that actually makes it really difficult to write options. So they are not immune to market declines, which is why they've attracted so much attention over the last couple of weeks. In severe bouts of volatility, they can still get quite big losses, which is, again, back to these first principles of diversification. Like, what are you trying to diversify against? Because there's no one magic diversifier. You've got to employ a number of different strategies. And you asked about 60-40, which is exactly the right question. That's come under a lot of fire over recent years because 60-40 portfolios struggle when you get inflation shocks where assets become correlated, like bonds and equities. So yeah, it's a part solution to volatility, but it's not a solution to downside protection per se.
Right. Okay. So essentially, then, what we're saying about what's happened over the last week, and we've looked at different factors that have influenced it. We've seen a prolonged period of very low volatility, which is not normal, and we had a bit of a shock because it seemed like there was a bit of a domino effect. We had US jobless, we had a decision by the Bank of Japan. It's all kind of happened at the same time. It then resulted in some technical factors. And we're not necessarily saying that carry trades or dispersion trades or covered call ETFs are bad. We're just saying they have their place. But when you get these extreme movements in volatility, as we saw over the last week, when the VIX went, something like from 20 to 60 or something like that, they don't work so well. And we need to get used to that, perhaps. Is it fair to say that we're going to get more? I mean, we've got a lot of things happening this year, haven't we? We've got the Fed at some point is going to start cutting rates. We've got a US presidential election. There's going to be more market shocks.
I think that's very fair. I think we are living in a world where there are latent idiosyncratic shocks. Now, remember, not trying to fearmonger here, because ultimately investing is about fundamentals. It's about the ability of companies to generate earnings in a consistent way. But the market isn't necessarily the economy, and the market is driven by a lot of things, and specifically emotion in the short term. So if you think we've got an abundance of idiosyncratic shocks, then yeah, it's likely we'll see more of this. And we should always remember, don't be complacent. Recognize we've lived through a period recently of very benign volatility, and that in itself can create instabilities in the system. So yeah, I think it's this is a more normal, natural market. When I was under a pressure about a week ago to call whether or not this was a correction or the start of a more sustained sell-off, I was very much on the side of it's a healthy correction. It comes back to the lessons we've learned from the GFC. The idea of serial correlation and systemic risk is at the forefront of every regulator's mind, and every CFO in every bank, and chief risk officer in every bank. People are very aware of the stability of the financial system and all those lessons that we learned in 2008. My point is that these trades, although they're quite exciting and they're quite scary when you're in the middle of them, the flows don't really indicate any broader problem in the system. It's just noise.
Yeah,
so it's not trivial noise; it's significant noise, but it will come back to fundamentals very quickly.
Yeah, and as you said, if you compare the size of carry trades versus the daily repo market in US Treasuries, it's actually relatively small. I mean, it's big, but it's not. It's a proportion of that.
Yeah, I think the human mind can't grapple with billions, let alone trillions, probably not even millions. But yeah, there are bigger forces at play. This is just one part of the market. It's an important part of the market, a significant part, but it's not systemic. It's speculative.
Okay. All right. Well, we'll hope you're right, David. But I think, as I say, there's going to be lots to watch as we sort of head towards the end of the year, and we'll be keeping you updated on Need to Know as and when. So a reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Thank you very much, David. Thank you for listening. Make sure you never miss an episode. Subscribe to Need to Know via Spotify, Apple Podcasts, wherever, and you can check out our previous episodes. And the one last week we did, when we reflected very quickly on what was happening in markets, and the one we also alluded to, and of course I don't have the date in front of me, which was when we talked about AI and what needs to be in place before AI, whether that's going to be influencing asset managers' decisions or how you write your next university essay. There's going to be a few things that need to be in place before that's working. Until next time, bye for now.